Good morning, everybody. It is September 7th, day after Labor Day, and we're going to do a quick run through of the Global Trends ETF report that I will be publishing here this morning. First off, stock market valuations continue to go higher with higher highs on the indexes, in particular S&P 500 and QQQ. I still stand by a 20 to 30% stock market correction is becoming more and more likely. And I think you'll want to continue to trim into these rallies and raise a little bit of cash. Quick note, I will be appearing tomorrow on Forex Analytics. So I suggest you take a look at that if you can. They have a YouTube page, and I'll be discussing oil and the transition to clean energy. Today, we just want to take a quick look at the stock market and do a little risk review. First thing we'll take a look at is where we are in the general progression. This is Shooter's Elliott wave chart. Clearly, there's a target that's a little bit higher on QQQ. And I think that probably that target doesn't get met, but it should get a little bit closer. I think that probably we see a correction as the taper becomes more imminent, and we also see the growth numbers start to slow down. The rebound from coronavirus is not over with, but the veracity of the move seems to be slowing down. So what can we take from that? Well, at some point, liquidity is going to slow down. This is the same thing I've been talking about for months now. I don't know how fast the stock market reacts to that. You know, there's people who talk about $5 trillion on the sidelines, but the reality is there usually is trillions of dollars on the sidelines, and that money never, ever, ever makes it into the stock market. So the excess money on the sidelines is maybe $1 trillion, maybe $2 trillion. But again, that's not an uncommon event. I do think that it is the cushion sitting in the smart money's pockets to buy things on the cheap. And given that that's smart money, I don't think they're just going to throw it in the S&P 500 index funds. They're going to be selective. And they're going to buy the things on our barbell that make a lot of sense to them to own over the long term. So here's our investing barbell. When the next correction comes and the wealthy who comprise most of the money on the sidelines, the smart money, decide to start buying, again, it won't be the S&P 500 index. Get to the point where you can understand why in a couple minutes. They're going to focus here. Tech and communications, industries that are tech leaders, consumer discretionary, alternative energy, and biotech. Same places they always go. And biotech at this point pretty much includes some of the big pharmas. And they'll also buy more real estate and gold. I don't think crypto. I think that that is more of a retail thing that we buy a little bit of on our personal accounts just in case. I don't really look at it as a hedge. I look at it as what if the world changes more than I think it's going to change. So I do want to have a little bit of Ethereum, a little bit of Bitcoin, but I'm not buying Bitcoin now. Materials, again, alternative energy, and then private equity, other types of alternatives. That's where the smart money is going to go. So my long-term view, the S&P 500. My long-term view of the S&P 500, again, is we might be in a higher channel permanently. The red lines outline what was the channel before. So I don't know if there's a permanent impact of the QE to move the channel higher. There could be. Could be. But as an investor, you should be aware of both potential paths. And ultimately, the market does always go higher. Sometimes it just takes a period of time. And I'm suspecting that we get one of those periods of time where we have 6, 7, 8, 9, 10 years pass before we really break out again. In other words, enjoy this while you can, because I think that there's a long-term choppy period coming. Take a look at the RSI, stock market's overbought again. Now, 100% of the time, when it has a sustained RSI reading above 70, you get a 5% correction. Almost had it right here. Now it's back up. Can it keep going higher? Certainly it can. But if it comes down and you get a move down into here or lower, but into here, that'll be more along the lines of that 20 to 30% correction. So this is over at Forex Analytics, is what they say. There are still many sources of uncertainty in the world, but equity markets seem to be shrugging them off without a second thought, right? Nobody cares about risk right now. The unprecedented global stimulus is reason enough to be bullish, but at these extremely rich valuations, it's difficult to be long. So they're saying it's probably prudent to wait for a proper pullback before getting more involved in the stock market. And their chart shows, you can kind of see how the channel is working, that the advancers, there's not as many of them anymore. They're already there. So the chart you're seeing, there's only two things that can happen. We get a rocket ship to the moon, or it has to break down. And their first levels down are here. And then, they're looking back to that 2015-16 period, which I told you was the base of the stock market 2-3 years ago. This is the base region. Will we ever see it down here again? I don't think so. I think if coronavirus wasn't going to break us below this line, nothing will. And I think that this line is probably unlikely to even be met either. But this is probably about as low as I can see it going ever again, 2,400-ish on the S&P 500. But my chart is considerably higher. I have a hard time thinking it'll get below, 290. I just see this area here potentially being a new baseline, because the money that's in the market is in the market now, right? It's not going to disappear. They can tighten liquidity, but they're not going to tighten it so much that they cause a recession. I think that this is probably as bad as it can get, 290-ish on the S&P 500, and it might stop right around 350-ish, which Shooter also talked about. Shooter's line is also right around 350-ish. This 200-day moving average is about 315. So if we go through here, then I think, then you can probably get your 290. And then you start your rally back up. The only way it keeps going down all the way down to this range is, again, if we have some sort of Armageddon scenario. But let's talk about valuations. The 12-month trailing PE is about 35 right now on the S&P 500. And it had touched a little over 40 for a hot minute. And the thing to think about here is that the comparable levels on PEs were very low a year ago, right? Now everybody's earnings fell off a cliff. And now we've rallied all the way back up to record earnings. How do you look at that? In an era where supply chains are moving, unemployment is all unsettled, and the consumer is probably going to slow down once we get past Christmas. I think you have to believe that the E in earnings is going to be under a lot of pressure early next year to rise anymore. And we have to consider what does come out of legislation. So the E, I think, is at much more risk today, coming off of low inventories and a surge in demand, going into a period where inventories start to improve, but labor costs go up, and legislation, taxation, regulation, all become a little bit more difficult. So if you take a look at this one, which is hopefully a bigger chart, there you go, from a Yardeni, you see that the large cap PE, forward looking, still over 20, where 16, 17, 15 is more normal. Look at the mid caps. Mid caps have come down, and the small caps have come way down. So you have a small cap PE around 16 versus large caps at about 22. Does that make any sense at all? No, because small cap companies grow faster than large cap companies. So the PE on the small caps should realistically be higher. So you're going to see a convergence. PE on large caps is going to change, probably come down a little bit. Because if the E comes down, the P will come down more. And right now you can be cherry picking small caps. I wouldn't buy an index in the small caps. Why? Because in markets that are highly efficient, like the large cap space, just buying QQQ is pretty much good enough. It's going to be hard to beat QQQ. But beating S&P is probably pretty easy. And in a market like IWM, which is the small caps, you for sure just pick out a dozen stocks, maybe 20. Because you can outperform an inefficient index. Inefficient indexes are places like emerging markets, country specific, small caps, micro caps, places where there's more volatility, right? Less efficiency are places where you pick. Places where there's less volatility and more efficiency, just buy the index. And as I've talked about many, many times, QQQ is a better index than S&P. Let's take a look at who's doing what right now. A couple of times, the smart money and dumb money have moved in tandem here since the start of the coronavirus crisis, which is not a super regular thing. It doesn't last very long when it happens. Well, now we see smart money's been selling in the last few months, last couple of months, really, since August. So it really only about 4 weeks. And the dumb money is pumping back in. And again, you can see that this trend for the dumb money seems to be weakening, but has a possibility of maybe breaking out one more time. But I think if we watch this, if this gets up here again, that'll be a sell almost everything event. I'm not so sure it's going to crack this line again. I think things get a little bit more boring than that, a little more mundane. Think downhill rapids versus over the cliff waterfalls. This is intermediate term. You can see that the intermediate term index is starting to get overzealous again in a trend that's weakening. Now, if it breaks up above about here, that means that we're getting a peak in optimism that should be sold. And if it bounces back down here, it means it's continuing a trend of weakening optimism. Either way, you've got to be real diligent about trimming on these rallies. And I actually think we're within 2 to 6 weeks of seeing this market get quite a bit more rough. Now, QQQ comparison to S&P, notice that the potential dip on Shooter's chart is much smaller than it is on the S&P. Why would that be? The top holdings in QQQ, which are also the top holdings in S&P 500, hold about 70-75% of all the cash on corporate American balance sheets. Most profitable companies in the world for the most part. So if 100 stocks on QQQ hold 3/4 of the corporate cash, what does that say about the other 400 stocks on the S&P 500, right? Because all the QQQ stocks right now are on the S&P 500 now that Tesla's on. So if 100 stocks have 75% of the money, if 400 stocks have 1/4 of the money, what does that say about the rest of the S&P 500? That's just not very good, right? I expect this relative performance for QQQ versus the S&P 500 to continue. So anybody out there who, thinks about investing in QQQ versus SPY or VOO, I think it's pretty clear. The S&P 500 is not that great of an index. Now, some of the stocks that are the smaller end of the spectrum in the S&P 500, the higher growth ones, the ones that are heading in the right direction, versus the companies that are shrinking towards the bottom, right? Your recent additions to the S&P 500 are good places to look. But your companies that are shrinking, like most of the oil companies, at this point, and this is what I'm going to be talking about on Forex Analytics, these are a lot of companies that are really good short candidates as the transition to clean energy occurs faster and faster. So any company shrinking out of the S&P 500, you pretty much want to ditch. Emerging markets are one of those inefficient markets. The problem with buying emerging market stocks individually, if you're not a really good international stock picker, is that you can make mistakes. A lot of mistakes of information. So you really just have to look for those pockets in emerging markets where you're going to get the best performance. And your asset-light companies, like those in internet and e-commerce, cloud companies, things like that, are going to probably do the best. There's a problem there too. You've got all the commie stocks out of China. So do you want to buy Alibaba and Tencent individually, or do you just want to have a smattering of them as a components of an index that you buy? So for me, I just don't have any stomach for the risk involved with buying individual commie stocks. So I'll buy this index, and although Alibaba's in here, JD is in here, and Tencent is in here a little lower, it's a smaller percentage, right? 6% of this, your Chinese stocks are something along a quarter of the holdings or 30% of the holdings here. I get a global basket of emerging markets, which are crushing EEM, right? So this is EEM over a long period of time, going back to 2015, 16. But again, the asset-light company. So just like QQQ versus SPY, this is a similar sort of dynamic. And interestingly, it hit exactly on that 618 line. So I want to ask Shooter what he sees about EMQQ here, because I think there's one more leg down. And I think that this area here is in play. So let me bring him on for just a second.
You got me?
I got you. So if you just eyeball this, does this look like an A, B, C, or 1, 2, 3? I mean, does this look like it would have one more leg down? This would have to me, this looks like it kind of have to morph into a 5-wave.
Yeah, well, it looks like a double zigzag right at the moment, which, obviously the next stage down would be, another ABC to the lower side, which ultimately is a 5-wave in how they combine. So, but yeah, I've got a 5 down on EMQQ down to 47.23. So we would still put in a 56.40 and then come off, which is right about where we are, I think.
Right. So another retest of this 618 line that I got here, because that's about what that is.
Yeah, you've got the three that was put in. It's a ending diagonal up there is what it is. So it basically turns into what looks like a flat right there.
Okay. Maybe a double bottom rather than a new low. So
it would look like it would look your prior low was 47.56. The count says the next low will be 47.23. Hey, it's a double low, a double bottom.
Okay. So then when it gets down to around here, we have to pay attention to see if it's going to bounce again or keep going down.
I would say that, I would say that would be its floor. Just looking at the the structure of the wave count that's there, especially if you go back to our 5 at 81.73, which goes back until January of 21. And then you look at where our 2 was in at 26 back in just around April 20. Structurally, it would follow the stair-stepping pattern of a trend up. So you had, you've got your higher high in and your higher low. Typically that is a 3-step motion. So I would think that we would put in another higher high at least, and then at least one more higher low above that bottom that we have down here off of our 5, which is that 48 and change. So we would put in that 47.23, which would become our final higher low on that, just that stair step motion up.
In studying the top holdings here, which I've done, I will say quite a few of these are at pretty high PEs, and their PEG ratios are a little closer to 2 rather than 1, and I like them closer to 1. I think if valuations matter, and that hasn't mattered a lot lately, if valuations matter, for sure we're going to get to here, and I don't think this is out of the question, and it's just a huge support level here. I mean, didn't get through, and then it did. 40-ish I think is in play, but 48-ish I think I have to get involved the next time. So whether that's selling a put or a starter position with a put, one way or another, when it gets back to about the target right here, I think I'm going to get involved. Might be small, might be a starter position and selling a put. I think that this is a really good spot to do that, to be honest, because if it comes down here and it gets put to you, great, you've averaged in at 2 really low prices, and if it bounces and it leaves you behind, you still have a great cost basis on a small long-term position. Anything you want to add about the S&P 500 or QQQ?
Not that you specifically, except I think you can chase the Qs this week. I mean, if anybody wanted to that 388. I'm in 383s right now. I didn't throw them in because I was doing the dailies, but it looks promising. I think we push with the month end here. I think we're seeing enough volume to keep it going. So outside of that, nothing.
Okay. So if people wanted to chase this up, and I talked about that earlier, if people wanted to chase QQQ, that's probably the place to do a little chasing. And the ultimate correction probably is less intense than on the broader S&P 500. Okay.
Right.
All right. I will get this published here in the next couple of minutes when I finish up with the emerging markets thoughts. And the small caps, that's where the valuations are on your side. That's where growth is on your side. You're getting big put premiums, right? Because of the volatility and the pessimism. I haven't seen small caps be relatively this attractive to large caps in a long time, to be honest with you. So I think you really wrap your head around finding the good small cap ideas that fit your risk tolerance. And again, I've been pounding the table a little bit on this lately. For those of you who aren't doing it yet, learn how to sell cash secured puts. I have links out there so that you can learn how to do that. All right. Have a great and go Brewers go.